If you are waiting for a signal that the financial system is breaking, stop looking at the stock market. Stop looking at the VIX. Look at your email inbox. Yesterday, silver smashed through a record all-time high of $89. It is a historic breakout, the moonshot we have been waiting for. But at the exact moment the price went vertical, the United States Mint sent this to their top distributors. Read the fine print. Rapidly rising silver prices may result in silver numismatic products being temporarily removed from sale. They call it a pricing adjustment. I call it a liquidity freeze. I call it a soft default. Because what is the value of an asset that hits $89 on a screen if the sovereign mint of the world's reserve currency refuses to sell it to you? This isn't a logistics error. This is panic. The US Mint operates on thin margins. When the price of physical silver moves faster than the bureaucrats can update their spreadsheets, they have two choices: lose millions of dollars selling to you at yesterday's price, or lock the doors. They chose to lock the doors. And here is why they are panicking. While New York traders are celebrating $89 silver, the Shanghai Gold Exchange just clocked a price of nearly 22,400 yuan per kilo. Do the math with me. That is $100 per ounce. Right now, as we speak, there's an $11 arbitrage gap between the West and the East. That is a 12% premium just for moving metal across the ocean. This is an economic vacuum. It is sucking every available ounce of physical silver out of London and New York and shipping it straight to China. The US Mint knows this. They know their inventory is being raided, so they pulled the buy button. While the physical window is slamming shut, the paper window is being thrown wide open. The CME Group, the people who run the COMEX casino, just announced they are launching micro 100-ounce silver contracts. Think about the timing. Physical metal is disappearing. The East is paying a massive premium. The Mint stopped selling. And suddenly, the casino offers you a cheap paper ticket to play the silver market without ever touching a bar of metal. They are trying to divert your demand. They want you betting on the price action, not holding the collateral. They are selling tickets to a lifeboat that doesn't exist. Why? Because the system is cornered. And when the house is cornered, they don't just change the odds. They change the rules of the game. And if you want proof that the rules are being rigged against you in real time, you need to see what just happened in the Japanese bond market. Because it's about to trigger a nuclear reaction here in the US. Let's cut through the noise. What we are witnessing right now isn't just a bull market. It is a hostage negotiation between the paper markets and reality. For decades, the price of silver hasn't been determined by how many ounces come out of the ground. It's been determined by how many paper contracts are traded in Chicago and London. They call this price discovery. But when you look at the new rules coming out of the CME Group this week, you realize the discovery is over. The cover-up has begun. We need to talk about variable margins. I know margin requirements sounds boring. It sounds like something only accountants care about. But in this specific moment, it is the weapon they are using to kill the rally. Here's the old way it worked. You want to buy a silver contract? You put down a fixed deposit. But the CME just changed the physics of the casino. They are shifting from a fixed dollar amount to a percentage-based margin. Why does this matter? Imagine you're playing poker. You have a winning hand. You're betting big. But suddenly, the house manager walks up to the table and says, "Hey, because you're winning so much, every chip you put in the pot now costs you double. As the price of silver rises, the cost to stay in the trade now rises with it. It acts like a gravity well. The higher the price flies, the heavier the boots become for the traders trying to ride it up. They tell you this is to reduce risk and ensure stability. The reality is, this is a speed bump designed to force leveraged longs to sell. They are trying to bleed the momentum out of the market by making it too expensive to hold a winning ticket. But the margin hike is just the defensive line. The offensive play is this new 100-ounce futures contract we mentioned in the intro. You have to ask yourself, why now? Why, in the middle of the most aggressive silver breakout in history, is the world's largest derivatives exchange suddenly worried about the little guy? Listen to their press release. Silver is increasingly appealing to retail traders. 100-ounce futures will improve access, enabling them to benefit from the liquidity. Translation: we need your money, but we don't have the metal. Here's the mechanism. When you buy a physical coin, a silver eagle, a maple leaf, you are removing supply from the market. You take it home, it sits in your safe. That metal is gone. It cannot be rehypothecated. It cannot be sold to anyone else. It is off the board. But when you buy a 100-ounce futures contract, you aren't buying metal. You're buying a price exposure. This new contract is a sponge. It is designed to soak up the flood of retail capital that is panicking out of the dollar. They know millions of people are waking up to inflation. They know you want silver. If 100,000 retail investors buy 100 ounces of physical silver each, that is 10 million ounces drained from the vaults. That breaks the COMEX. That creates a default. But if they can convince those same 100,000 investors to buy a micro-future contract instead, 0 ounces leave the vault. The price pressure is absorbed into the paper casino. You get a digital receipt that says you own silver, and the bullion banks get to keep the real metal for themselves. It is the oldest trick in the book. When you are running out of product, start selling rain checks. However, there's a flaw in their plan, a fatal flaw. They are assuming that the margin hikes and these new paper contracts will scare people off or distract them, but they are underestimating the psychology of this market. We are not in 2011 anymore. The people buying silver today aren't just looking for a 10% gain. They are looking for insurance against a collapsing system. Ironically, the margin hike I just told you about, the one designed to crush the price, it might actually accidentally trigger the mother of all short squeezes. Think about it. The margin rules apply to everyone, not just the longs, the buyers, but the shorts, the banks betting against silver. If silver spikes $5 in a single day because of a geopolitical event, which we will discuss in a minute, those short sellers are now on the hook for massive variable margin calls. The higher the price goes, the more cash the shorts have to post immediately. If they run out of cash, they are forced to cover. That means they have to buy silver to close their position. This is where the transition from systemic stability to systemic fragility becomes visible. As of late 2024, industry reports indicate that the nature of the buyers in these hubs is shifting. In the old era, central banks bought bonds to hold them for decades. In the new euro-dollar-driven era, the buyers are increasingly leveraged hedge funds and private intermediaries. These ghost buyers aren't looking for a safe haven. They are often engaged in the basis trade, a high-risk strategy that exploits tiny price differences between Treasury futures and the bonds themselves. By using the UK and Belgium as a shield, the identity of the ultimate owner is obscured. It is no longer a transparent relationship between two sovereign nations. Instead, the US debt market is becoming a web of offshore accounts and leveraged trades. While this proxy shield allows the market to appear stable on the surface, the underlying plumbing is being filled with more volatile short-term capital. As China pulls back its official transparent holdings, the global financial system is increasingly reliant on this opaque euro-dollar shadow, a shift that makes the world's most important market harder to track and far more susceptible to sudden violent liquidity freezes. While the proxy shield of Belgium and London masks the movement of sovereign wealth, there is another line item in the Treasury Department's TIC report that reveals the true structural fragility of the modern financial system: the Caribbean banking centers, specifically the Cayman Islands. As of the most recent data through late 2024, holdings in these offshore hubs have seen a documented surge, often moving in inverse correlation to the decline in official Chinese holdings. But these aren't nation-states building a strategic reserve. This is the footprint of the leveraged tremor, the leveraged ghost, a network of private hedge funds that have become the unintentional backstop of the US government's debt. To understand the danger, we have to look at a highly technical maneuver known as the basis trade. Analysts suggest this trade is currently one of the largest concentrated risks in global finance. In its simplest form, the basis trade is an arbitrage strategy where hedge funds exploit a minute price difference between the cash price of a treasury bond and its price in the futures market. Because these price discrepancies are often fractions of a penny, the trade only becomes profitable when it is magnified by massive amounts of debt. According to the Federal Reserve's financial stability reports from the second half of 2024, the volume of this trade has ballooned into the trillions. To execute it, a hedge fund buys a treasury bond and immediately repos it, meaning they pledge the bond as collateral to borrow cash, which they then use to buy more bonds. They repeat this process until they are leveraged at ratios as high as 50 to 1. Through this cycle, the ghost buyers in the Cayman Islands have effectively replaced the sovereign stability of the people, S Bank of China, with speculative short-term capital. This is where the forensic mystery meets systemic fragility. In the old era, when China or Japan bought a treasury, they were long-only investors. They held the asset for years, providing a floor of stability for the US economy. They didn't have margin calls, and they didn't have stop-loss orders. If the market became volatile, they simply waited. The leveraged ghost operates on a different set of rules. Because these hedge funds are operating on razor-thin margins with 50x leverage, they are hypersensitive to even the smallest market tremors. If the cost of borrowing in the repo market spikes, a metric institutional analysts monitor through the SOFR rate, the math of the basis trade breaks. When the math breaks, these funds are forced to unwind their positions instantly. They must sell their treasuries at any price to pay back their lenders. This creates a liquidity black hole. Industry reports indicate that in moments of stress, these leveraged players don't just stop buying, they become forced sellers. We saw a preview of this in March 2020, when the Treasury market, the most liquid market in the world, functionally froze, requiring a multi-trillion-dollar intervention from the Federal Reserve to prevent a total collapse. As of late 2024, the US Treasury market has reached a historical paradox. On the surface, the bid for US debt remains strong, but the quality of that bid has deteriorated. We have traded the financial nuclear deterrent of mutual sovereign dependence for a leveraged ghost of speculative arbitrage. The US government is no longer just funding its deficit through the kindness of strangers. It is funding its deficit through the risk appetite of offshore hedge funds. The foundation of global finance is shifting from the solid granite of sovereign reserves to a high-speed, glass-thin architecture of leveraged debt. If the basis trade fails, it won't just be a bad day on Wall Street. It could be the moment the plumbing of the global dollar system finally bursts. This structural shift marks the transition from strong hands to weak hands. For decades, the primary buyers of U.S. debt were sovereign central banks, the strong hands. These institutions, like the People's Bank of China, operated with a multi-decade horizon. They weren't hunting for arbitrage, they were managing national reserves. As of data through late 2024, these stable, long-only buyers are being replaced by the weak hands of the leveraged shadow banking system. The difference is existential. The central bank does not receive a margin call. If treasury prices drop, they simply hold the bond to maturity. But for the leveraged funds operating out of the Cayman Islands, the math is unforgiving. These players rely on the repo market, the financial plumbing where bonds are swapped for short-term cash to maintain their positions. Industry reports indicate that when volatility spikes, the haircuts on collateral increase, and the cost of borrowing, monitored via the SOFR rate, can surge in a matter of hours. Analysts suggest this creates a fragility fracture. In the old system, a sell-off was met with sovereign indifference. In the new system, a price drop triggers a forced liquidation. As the value of their collateral falls, hedge funds are hit with margin calls. To raise cash, they must dump more treasuries into a falling market, creating a self-reinforcing death spiral. According to recent Federal Reserve financial stability assessments, this is no longer a theoretical risk. The plumbing of the global dollar system is now so interconnected with these high-leveraged trades that a tremor in the repo market can freeze the engine of global commerce. This is why China's retreat is so significant. The U.S. has traded the geopolitical tension of a sovereign sell-off for the systemic volatility of a hedge fund collapse. We have moved from a world of strategic competition to a world of structural fragility, where the next margin call could be the one that finally bursts the pipes. While the transition from sovereign buyers to leveraged funds creates a more fragile system, it also leaves a trail of high-frequency data. Institutional analysts monitor specific macroeconomic indicators to gauge when the plumbing of global finance is reaching a stress point. These are not just numbers, they are the pressure gauges of the dollar system. The first signal is the Secured Overnight Financing Rate, or SOFR. As of the latest reporting cycles in late 2024, SOFR serves as the primary heartbeat of the repo market. Economists look for sudden spikes or widening spreads between SOFR and the federal funds rate. Such anomalies suggest that the leveraged ghost, those offshore hedge funds, is struggling to find the cash needed to roll over their positions. Analysts suggest a liquidity crunch here can force an immediate systemic liquidation of Treasury holdings. Next, experts track the gold-to-Treasury ratio as a barometer for risk-off sentiment. Historically, When gold begins to decouple from and outperform treasuries during periods of rising yields, it suggests a fundamental shift in how the market perceives safety. Industry reports indicate this ratio is often a leading indicator of sovereign-level anxiety regarding the dollar AS long-term stability and its role as a reserve asset. Finally, macro strategists watch 3-month T-bill yields for signs of collateral scarcity. If yields on short-term bills drop sharply while broader market volatility rises, it often signals a desperate scramble for high-quality collateral to satisfy margin calls within the shadow banking system. While these metrics provide a window into systemic health, they are for educational purposes and do not constitute investment advice. They represent the institutional checklist used to monitor a world where the bedrock of the global economy is shifting from the solid hands of central banks to the volatile, glass-thin architecture of private leverage,